The last of the three financial statements that we want to look at is the balance sheet. So the balance sheet tells you how much you own today or how much the company owns today. So it indicates the financial position or the strength of the company. So in the balance sheet, you will get a good clarity of how much assets they have and how much liabilities they have. And with a simple formula, assets minus liabilities, you can check or calculate the equity of the company. So in the balance sheet, you would see current assets or current liabilities. So these are below 12 months, which means that, for instance, current assets are assets that you can liquidate or cash out within 12 months. And non-current assets or non-current liabilities are above 12 months. Again, if we use an example of non-current assets, we are talking about assets that we can only liquidate or generate cash from it very likely after a 12 months period. Starting off with the assets on the balance sheet. So typically you will look at a year-on-year comparison. So we have spoke about non-current assets being assets that cannot be converted or sold within 12 months or less. So you typically have property, plant, and equipment as an asset because as a company, if you own the building or if you own the land, these are basically the property that you own, that the company owns. You have intangible assets, mainly intellectual properties like patents, copyrights, or trademarks. So for instance, the patent of an iPhone, the brand of Disney, these are intangible assets that has a value. Then you have investments that are not intended to be sold in 12 months, for instance, bonds or stocks. And some other assets that are not classified in the above categories. Yeah, but typically you would see property, plant, and equipment, intangible assets, and investments. For current assets, as we have mentioned, these are assets that can be converted or sold within 12 months or less. So very common, you would see cash and cash equivalents. So these are referring to the cash or fixed deposits that you have in the bank. Receivables, this is money owed by customer to the company. You have inventories, raw materials or ready products in stock. So the products are physically in your warehouse, there is a value there, so you have to record this as an asset. And other current assets that are not classifiable in the above categories. So if you add both of the non-current and the current assets, you will get your total assets. In this example, in the year of 2018, you have 527 million in total assets. On the other side of the balance sheet, we would have the balance sheet recording liabilities. So we start off with non-current liabilities. So liabilities that are expected to be paid after 12 months. So liabilities are debts, right? Or things that you owe people, for instance. So you have long-term debt owed. So for instance, like the company bonds. And you have other liabilities that are not classified or classifiable in the above categories. And then you have current liabilities, which are liabilities that are expected to be paid within 12 months or less. Short-term debt, which is short-term borrowings from the bank. Payables, money that you owe the suppliers for the products, goods, or services that you use. Payroll, so salaries that is owed to the employees. It's a liability because it's something that you have to pay in the next 1-2 months, for instance. And other current liabilities that are not classified above. So adding both the non-current and current liabilities, you will get total liabilities of 222 million in the year of 2018. So if you remember the simple formula, equity equals to total assets minus total liabilities. So in this example, 305 million, you can take it as the net worth of the company, assuming that you shut down today, you sell all your assets, and you taking off all your liabilities, and this is how much equity or value you are left with. We have covered the three financial statements. Firstly, income statement that records how much money is made by the company. Cash flow statement records how much money is being moved in and out, physical cash of the company. And lastly, the balance sheet, which shows the financial position or strength of a company. So these three financial statements are important to judge and evaluate if the company is doing well or is in a good financial health. There are a lot of terms that you might not fully comprehend or understand, but it's important just to understand what these financial statements serve and what kind of value you are looking at. So we'll cover a bit more later on in this course, how to evaluate and look through these statements in more details. Thanks.